The best thing about the stock market is this: regardless of what's going on, you can always find good deals if you look hard enough and are willing to wait. Patient investors know the value and power of dividends. Good dividend stocks can help stabilize your portfolio and pay you for being patient. That's why today I have 3 solid dividend stocks for all you people looking for a juicy dividend. First of all, we have Kroger, trading under KR. Kroger is a food retail giant in the US with almost 430,000 employees, 2,719 supermarkets and multi-department stores, 2,252 pharmacies, 1,637 supermarket fuel centers, and on and on. Basically, Kroger is massive. They have made almost $150 billion in revenue last year, up from almost $100 billion in 2014. Their net income margin is a bit slim, only 1.52%, slightly under their 5-year average of 1.77%. This looks worrying, but the reality of the food retail industry are the low net margins. There is no way around it. It's the industry that focuses most on cheap prices and efficiencies. We can see that in the levered free cash flow margin too. That stands at 1.34%, slightly lower than the 5-year average of 2.06%. The good thing is that the return on equity is high, standing at 23.23%. This is below the 5-year average for Kroger of 27.55%, but above the sector median of 10.56%. With return on equity, anything over 20% is good, and the good thing with Kroger is that this is sustainable and normal for the company. The return on assets is lower at 4.52% compared to the 5-year average of 5.23% and sector median of 4.17%. Kroger does have $10.1 billion in long-term debt, but they have started to pay it down. They also have $1 billion in cash, which can provide stability. Now, I like Kroger because of these 4 reasons. First of all, Kroger is a good dividend growth stock. The 3, 5, and 10-year compounded dividend growth rates are between 14 and 17%. The expectation is that this will continue for now. Even though Kroger has a relatively low dividend yield of 2.11%, long-term investors can expect that this yield will just keep growing. Second of all, Kroger has been buying back so many shares. In 2014, Kroger had just over 1 billion shares. As of last year, Kroger had 717 million. That's a reduction of close to 30% in less than 10 years. The less shares there are, the less Kroger spends on dividends and the more ownership the existing shareholders get. Then, we have expected growth. Kroger is expected to grow their earnings per share by an annual rate of 10.3% over the next 3 to 5 years. For a food retail business, 10% EPS growth is extremely solid. This brings me to my final point. Kroger is really good value right now. Their growth is priced really cheap as their PEG ratio is just 1.07, well below their 5-year average of 1.83 and the sector median of 2.51. Their forward PE is also relatively low at 10.96 versus the 5-year average of 12.27 and the sector median of 18.83. Their forward book value is neutral at 2.82 versus the 5-year average of 2.87 and the industry median of 2.94. The current consensus price target stands at $52.85, so it offers a small 7% upside in the short term. Overall, Kroger is a solid business with a growing dividend and it is currently trading at a good price for long-term investors. Next on the list, we have Phillips 66 trading under PSX. Phillips 66 was essentially a refining company which takes crude oil and produces gasoline, diesel, jet fuel, and so on. Recently, Phillips 66 has acquired midstream to expand their natural gas liquids or NGL operations. Now, the refinery business is very cyclical, going through ups and downs. Currently, the management of Phillips 66 considers us to be in the middle of the cycle. Because of that, they have committed to returning between $10 and $12 billion to shareholders by the end of 2024. For context, the company is currently valued at $46.7 billion. These cycles are extremely important to monitor because buying at the wrong time can be painful. However, buying at the right time can be extremely profitable. Recently, we had a price dip because of falling oil prices. We saw Phillips 66 falling to a 6-month low of $91. The stock has since recovered to $101 $21.4, and honestly, I'm kicking myself for not buying it. Despite that, the price still offers a good entry point for long-term investors. Personally, I think that Phillips 66 is currently a very attractive dividend stock. They have a yield of 4.1% right now, and the management has been crystal clear that they are not planning to reduce or stop it. Also, the management has only returned $2.4 billion out of the 10 to 12 billion they committed. That's why we can expect higher dividends, we can expect more share repurchases. Phillips 66 brought down the number of outstanding shares from 590.2 million in December 2013 to 438.3 million in 2021. Unfortunately, they issued more to fund their acquisition of Midstream. Currently, their outstanding shares are 465.8 million, and that is still a reduction of 21% since December 2013. The management has also strongly hinted that they are planning to repurchase shares at a steady pace of $2 billion a year. Another massive green flag for me is this: Phillips 66 is expecting cost cuts and efficiencies from the Midstream acquisitions. These mean better margins and more cash for the shareholders. Basically, Phillips 66 is in a good place right now. The company is solid, it has a steady dividend, and it offers you a very good exposure to the oil and gas sector. Personally, I am planning on opening a position over the next few weeks. Quick side note, I recorded this before the recent OPEC news of cutting down oil production. This has sent oil prices up, and oil companies like Phillips 66 have followed. Even though this makes Phillips a bit more expensive, I think it just makes the bull case for the stock even stronger. Finally, we have Innovative Industrial Properties trading under IIPR. I actually talked about this stock roughly 1.5 months ago. Since then, the price has gone down about 10%, meaning that this dividend stock has become an even better deal. Here is why. IIPR is a REIT focused on the cannabis sector in the US. They buy, own, and manage specialized properties that they lease out to state-licensed operators. In essence, IIPR is a big cannabis landlord. As such, their business model is simple enough. They find good renters, they collect the rent, they profit. Simple, right? IIPR have a few things going for them. 1. The cannabis sector in the US is growing, and IIPR is the biggest publicly traded cannabis REIT. That's why, if you want to get exposure to this sector, IIPR is a very good way to do it. Bigger companies also tend to be safer. I prefer to avoid the small players in this space because it is still evolving and fragile. Plus, getting the landlord instead of the cannabis company ensures a steadier cash flow. A lot of the cannabis companies are not established enough for my personal taste. 2. IIPR has one of the lowest debt-to-equity ratios out of the American real estate investment trusts. They have $2.1 billion net property, plant and equipment versus only $300 million in long-term debt. That's a debt-to-equity ratio of 14%. Plus, given the fact that they made $152 million last year, IIPR can completely pay off their debts in the next 2 years if they wanted to. The low debt also means that IIPR has available options to speed up their growth if they wanted to. That brings us to argument number 3. The company has seen explosive growth over the last few years, and it has a lot more room to grow. IIPR has gone from only $14.8 million in rental revenue to $276.4 million in the span of 5 years. As I said, the cannabis sector is still new, so IIPR has the first mover advantage when it comes to cannabis real estate. The fourth reason is that IIPR's book value has kept expanding. In 5 years, their tangible book value has gone from $25.6 per share to $69.28 per share. Tangible book value is crucial for REITs because that's how they generate revenue. Seeing this type of growth with IIPR is a big green flag. Finally, the fifth reason why the company is so appealing is their dividend. Their dividend yield is 9.5%, which is sky high. Not only that, it has been growing rapidly. The annual dividend growth rate for IIPR is 55% over the last 5 years. Analysts expect it to grow by another 10% this year, which is solid. At a price of about $76, IIPR is an incredible bargain. I started buying the stock when it was $85 and I intend to continue. There are some caveats to IIPR and I've covered them in my previous video about them. Head over there if you want to check them out. Remember people, if you cannot find a good dividend company to invest in, you can always just buy a solid dividend ETF like the Charles Schwab US Dividend Equity ETF or the Vanguard Dividend Appreciation ETF. With that, I'm wrapping up the video for today. Which is your favorite dividend stock right now? Let me know in the comments below. Please leave a like if you enjoyed the video and share it with your friends. Thanks for watching and I will talk to you again soon.